Hello everyone, welcome to another QuantInsti webinar, and this is your host Kshitij Maurya. Today we have a special session on artificial intelligence for portfolio management, and we will be joined by our very own Dr. Thomas Stark from Sydney, Australia. And I'll before passing on to Thomas Stark, uh, Dr. Thomas Stark is an expert in artificial intelligence and quantum computing domain, and a lot of you already know Dr. Stark, and is one of the esteemed EPAD faculty members, and has shared his experience with multiple times with our audience in the past. Now, Dr. Stark's academic background, so he has a PhD in physics and is currently uh, leading the quant trading team in one of the leading prop trading firms in Australia that is called AAA Quants as its CEO. And he has also held senior research fellow positions at Oxford University. Now, Dr. Stark has previously worked at a proprietary trading firm called Vivian Court, and he has also worked at Memjet Australia, which is a world leader in high-speed printing. And he has led strategic research projects from Rolls-Royce, and is also the co-founder of a microchip design company called P-Semi. So with that short introduction about Dr. Stark, hello, let's all of us welcome Dr. Stark. Uh, Hello, Dr. Stark. Thank you for joining
Hello.
us this from Sydney.
Thanks. Thanks, Kitty. Kitty, can you hear me?
Yes, I can hear you.
Okay.
And
Okay. Fantastic. So
great.
great. Thanks for the introduction. Hello, everyone. And welcome to this little seminar on artificial intelligence for portfolio management. Now, I already received an introduction from Kitty, so I don't really have to go into this spec again. Just want to let you know I've been in the markets for about 15 years and with fully automated trading, and I'm also running my company AAA Quants. So yeah, but without further ado, let's just move on. And I want to start with just a little introduction of why I built this course. And basically, I mean, portfolio management and the ideas around portfolio management in trading have been around for quite a long time, and they haven't really, well, they have obviously evolved quite a bit, but there hasn't really been some groundbreaking innovation. And in some sense, it is still very much as it used to be a long time ago. And basically, the idea of mean variance optimization based on modern portfolio theory is still the gold standard in portfolio management. And the problem with this is that it has some shortcomings, and they are fairly substantial. And in order to address those shortcomings, a lot of people have worked on more complex ideas of this mean variance optimization, but in its core, it's still more or less remained the same. Now, over many years using mean variance optimization, I basically came to the conclusion there is definitely a limit of what it can deliver. So it's for sure not a silver bullet to make every portfolio absolutely waterproof. So the question is, well, is there another way? And of course, with the ascent of AI, there has been at least the pointers or the avenues to perhaps a new way of looking at mean variance optimization. And so the question only is, how can we take the insights that we have from portfolio management from previous times, and can it apply to this new tool called neural networks or artificial intelligence or whatever name there might be, and really apply the success of AI in other areas to finance. Now, some of you already know me, perhaps, and you also know that I'm uh, while I'm using AI a lot, I always see AI more as a tool, and I'm not necessarily the person that gets overly excited about all aspects of it, but I still think it's a fantastic tool. Now, one of the interesting things is, and some of you probably will ask yourself, well, why do we even bother about portfolio management? But at the same time, if you're in the trading field, you obviously know that managing position is just as important, or most likely more important, than actually having a good trading strategy. So, there's several elements to a trading system. One is, of course, having insights, alpha insights, predictive models. The second one is portfolio or position management. And the third one is execution. Now, today we talk about portfolio position management. And one of the interesting things that especially people in the retail world, not so much in the funds management world, but even there, or the professional money management world, don't understand is that if you really want to improve your trading and make your strategies better, then diversification is probably what Harry Markowitz, the famous Nobel Prize winners, called the only free lunch in finance. So it's the only thing that you can actually apply to make your strategy performance better without actually having to pay much of a penalty in terms of your performance. So that's really important to understand. And when you use diversification, then it's absolutely imperative that you also have some sort of position management. How do we do this? Of course, classically, we've done it through mean variance. In the more modern times, of course, we look at something like AI. And what I really want to do is give you a bit of my knowledge of how to use it. Now, of course, a course like for AI for portfolio management can, of course, not cover every single aspect of portfolio management and of AI. But for most people, getting a step into this is actually a really valuable thing. And once you understand the basics, it's much, much easier than to go and adapt everything you need to know or need to use to your own needs. Okay, so I already talked a little bit about portfolio optimization. What is it? It's actually fairly simple. It's basically you size the positions in your portfolio and hopefully in your diversified portfolio to achieve an optimum balance between risk and return. And a lot of you will already know, well, risk divided by, return divided by risk is also called the Sharpe ratio. So in some sense, one aspect of optimal portfolio management is optimizing the Sharpe ratio or the risk-adjusted return of your portfolio. Now, in many cases, there's actually more than just that. Sometimes you want to avoid a specific concentration of sectors in your portfolio or some factor exposure, whatever. But in the simplest form, it's really optimizing your risk-adjusted return. And what that also means is that you want to achieve a diversification of your holdings, because generally, if you're well diversified and you have a bit of alpha in each of these diverse assets or strategies or whatever, you can actually optimize the overall performance of your trading. And that's really important. Now, as you can already see, I talked about the mean variance portfolio. This is actually what this means. So here we've got the rate of return on this axis, which is just a chart that I pulled from the internet, which is basically your average of returns. That's the mean part of the mean variance portfolio. And the risk is basically it's actually the standard deviation, but variance is basically another proxy for risk. So hence the name mean variance portfolio. Now in AI, we're effectively doing a similar thing. We also optimize the risk-adjusted return. Now, one of the really amazing things, and I talk about this a little bit later, is that we can use AI, in fact, to achieve things that can go beyond just optimizing risk-adjusted return, which is really quite amazing. So what's the advantage of AI? Let me just give you a few pointers here, because this is definitely really important, and specifically for those of you who have already been in this sort of more traditional portfolio management, they will notice this. So first thing is that you can actually incorporate alpha insights in the position sizing process. So for example, if you have any alphas, or in other words, some trading signals that you know have some predictive power, you can actually incorporate them in your position sizing process and make the position sizing even stronger than it might otherwise be. And that's not something that you can easily achieve with a standard mean variance portfolio, if at all. Now, the second part is, which is equally important, is accounting for nonlinear relationships between assets. So traditional mean variance optimization basically is a very strictly linear process, and it accounts for linear relationships between assets. Now, interestingly, neural networks or AI can actually also figure out and see those nonlinear relationships, which is pretty amazing. So it's definitely a step up from what we've already got. Thirdly, we can include temporal changes. What does this mean? Basically means that when our position returns change over time, and AI can actually take this into account. Now, a traditional mean variance portfolio only sees the current state of affairs. It only sees what's currently there. It doesn't actually see what has been maybe a few steps in the past, or quite a bit further in the past, or anything like this. Now, it's easy to see that if we have a system that can actually also take into account temporal changes rather than the current state of the market, we can probably extract some additional information out of this and then make our position management even better. And so definitely a very big important point. Now, what we've seen is, by testing AI systems on portfolio management, that overall it gives you at least an equal out of sample performance as mean variance in this very simplest case of using AI. But if you actually use all the power of the AI that is at your disposal, and you incorporate more alpha insights, you include more temporal changes, and so on, you can actually see that the performance out of sample from mean variance to AI improves by a great deal, which is quite quite a feat to achieve, because you can see this in literature. It's actually really difficult to really achieve any meaningful out of sample improvements with any technique of portfolio management. So here we can actually see a real distinct direct approach to do this. Okay, so what are the challenges? So now we decided, okay, we use AI for portfolio management, and we want to sort of build something. So how do we do this? You know, what's easy and what's difficult about it? Now the first thing is, how do we adopt a neural network to use it for portfolio management? Now this part is definitely not straightforward, and so therefore I actually built this course, because there is a few tweaks you need to do to a neural network or to an AI in order to make this actually work for position management and to achieve good out of sample results. Now, this talk obviously is a bit too short for basically showing you the programming skills that are required. What I can say right now is this is absolutely possible to do that. And even if you're new to AI, it's still relatively straightforward to learn. But of course, it takes a little while to learn it, because there's a few parts to AI, a few moving parts, so to speak, that you need to understand in order to make these changes, and also to adapt perhaps the AI system to your specific needs, because of course, we've got maybe some derivatives traders, we got people in crypto or futures, and everyone has a slightly different requirement for their trading strategies. So by understanding how an AI system is built and how it's been used for portfolio management, you can then take this and tweak it for your own requirements. The second challenge is, of course, and many of you will have heard about this, that generally AI systems have a large number of parameters, and it's very easy to overfit. So the question is, of course, how can we build a system, a testing system, a backtesting system that can avoid overfitting and that can actually produce not only good in-sample results, but also good out-of-sample results that we can trust. And so I will talk about this. There's a number of techniques that we can use. None of them is particularly complex, but it's important to understand the subtleties of these things in order to avoid actually falling into the trap of over-optimizing, say, a neural network, which can very easily lead to very poor results in the future. And you really want to make sure that this is not happening. Now, the third challenge is, how can you set up different types of portfolios? Now, really, the two main types of portfolios that are generally used is long-only portfolios and long-short portfolios. Now, setting up a long-only portfolio with an AI is actually fairly straightforward. After you've done a few tweaks, doing a long-short portfolio that also performs well and out of sample is a little bit more difficult. So I will basically show you how to do this. So there's a few things you need to rethink in the way you use different parts of the AI system, and then you can do it. But it's really just following a recipe and then being able to go ahead and implement it. It's, as always, once you found a way to do it and once you can see it, it's actually not that difficult. The hard part is actually in the first place, understanding what needs to be done to actually get there. But here we go. Now, the next challenge is, and I told this before, this is one of the advantages of AI, is how do you incorporate predictive factors? So a lot of the traders, they have trading models which have some sort of predictiveness to them. And of course, one thing you can do is, trade these models as a standalone, but then, you have then a model that trades standalone, you have a position management and so on. That's fine. But another way to do this and do this quite effectively is actually using your predictive models in your portfolio management. So you have these predictors that tell you something. And of course, if you know if you have some inkling about the expected return of your strategy going forward, then that should really inform your position management to some degree. Now, traditionally with mean variance, that's not really happening. You really separate the two completely. The nice thing that AI can actually do is, and it can do this in a very smooth way, is to incorporate your predictive models into the system by default. And again, to know how to do this, it takes a little bit of understanding the plumbing of the AI, but it's quite doable, and it can actually be explained in fairly straightforward, simple ways, which is really nice. So I just want to show you a little bit of performance data here. This is things that, or these are performances that I build up, and I show you basically during the course, all the code and everything that you need to get to this. So first of all, here we've got a traditional mean variance optimization, and we have a benchmark, which is basically just an equally weighted combination of buy and hold assets underlying these portfolios. And I want you to specifically pay attention to this. This is the a tech portfolio, so it consists out of a number of technology stocks. And you can see here we've got an in-sample Sharpe ratio of 1.07 and out of sample Sharpe ratio of 1.31. And it's actually that black curve here. So this is the performance of our tech portfolio, and anything past that dotted line is out of sample. So if we now go and we build the simplest possible long-only AI portfolio, so there's no bells and whistles, no predictive factors in there. It's literally just neural network. We've got it adapted to portfolio management, but nothing extra, just long only buy and hold. We can actually see that the performance of this is in fact very much the same as the mean variance optimization portfolio. So it already straight out of the box with no modification in the simplest case possible, we've got actually very slightly better performance, although very, very slight, than the mean variance optimization. And that's a pretty amazing thing that we can literally just go take this, plug it in, and actually get at least the same performance as we've had. Now that's our baseline, and from there things can only get better. And so during the course, I basically talk about how we can actually improve on this performance, and so how, you know, just by a few little tweaks, which are not even that big, I can show you, for example, how you can take this and you can improve the out of sample performance by quite a bit. So it went basically from 1.33 to 1.44, just simply by adding a few factors. Now, what you can see here is actually that the benchmark is really strong already from the start. So adding any type of portfolio management is generally not so easy, and to actually get real improvements of something like this over what has already been there with mean variance is not that straightforward. So to really start to have a good out of sample performance improvement is tricky, and this is where AI really shines. And you can see that you know, we can then build in long short AIs with alpha insights, and we achieve some really significant gains over the original portfolios. So basically, this is just a really rough overview of you know, stuff that we could do in the course. And what I want to emphasize is that, of course, this is not easy. That's why I actually decided to build a course around it, because it's not something that you can learn in like half an hour or so. You really need a bit of background, especially if you're new to AI. But effectively, when I came into this, I was quite fresh, and it's sort of the course that I built, that I would have loved to have if at the moment where I basically started working with AI. And I thought, all right, if there is a need for myself to do this, I'm sure other people would love to see this as well. So again, here's just a quick summary of various things that the course does. So what will you learn? It's basically, first of all, the basics of portfolio optimization. So it's effectively mean variance optimization and how you do it and how it performs and so on, just some basic stuff. Then the basics of AI, so just how to understand how AI works, how it works with respect to finance and so on. Then we learn how to set up an AI for portfolio optimization in Python, how to avoid overfitting. Then a big aspect of it is also how to manage long short portfolios, because that's generally a non-trivial problem, and AI actually once it's set up correctly, manages that quite beautifully, which is something that I specifically in my work building trading strategies can use quite a lot. And then finally, I already explained it. If we have some alpha insights, some trading strategies where we provide signals to the AI, we can also include them into our AI, and we actually get a much better position management. All right, so this is effectively the main bulk of what I wanted to talk to you about today. Now, I think there will be a lot of you that have a few questions, and I would be happy to answer them, because I know that I can talk here quite a lot, but actually it's often when you have the chance to question the experts that you get the most out of it. So I conclude this quick presentation for now, and I'm here to answer your questions. So please go ahead and ask whatever you like, and I really hope that I can give you some good answers to everything. And over
Thank
to
you for
you, Kshitij.
Yeah, thank you for the presentation, Dr. Stark. Now, I would like to request everyone to put their questions in the questions panel, since this entire session is supposed to be interactive, and you can ask any doubts, any questions that you have related to the topic. Just put them in the questions panel, and we will try to pick as many questions as possible in this session. And meanwhile, when you are putting these questions, I would also like to share one slide from my side also. So let me share my screen. And yes, so the thing is, I would like to share the new course that we have just launched, which is called AI for Portfolio Management and STM Networks. So Dr. Stark covered a bit about this in his presentation also. So this AI for Portfolio Management LSTM Networks this course is available at a flat 75% off. And I have shared the link of that in the chat, so you can benefit from that. Now, on top of that, there is another additional benefit for today's webinar attendees, that is the learning track. Now, this learning track consists of 5 courses, which are basically related to portfolio management, position sizing, and other quantitative methods. And our new course, AI for Portfolio Management, is also part of this learning track. Now, these 5 courses are already at a discounted price of more than 70%. But with the coupon that I have shared with you, WebLT, you will be able to get 34% additional discount on the current slash pricing that is there. So make sure to make the most out of it, and it will be active for next 4 hours only. So you can take advantage of that. And meanwhile, let me also start uh, picking up some of the questions that I have received, and I will start picking them one by one. So the first question, there are multiple questions. I have to shortlist them. Just give me a second. So this is an interesting question by Samir. Now, Samir is asking, um, are regime changes identified by neural network, uh, or any, or are they a part of alpha factors adjustment in your analysis?
All right. Thanks for the question, Samir. Now it's actually a very interesting one, because the first uh, the first problem we have with regime changes is you have to ask yourself, what is a regime change anyway? So there's a few ideas of what a regime change actually change actually constitutes one. So one could, for example, be that your autocorrelation structure in your data goes from negative to positive, so from mean reverting to trending. But there's also other regimes, like there could be a low volatility regime versus a high volatility regime, and so on. Now, when you have a sufficiently complex neural network, it will definitely pick up some of this. However, it will not necessarily pick it up explicitly. So it's not going to tell you, oh, this is what's happening. So in fact, what really needs to happen is, in these days, it's actually really hard to identify per se what a regime change is. It's not as straightforward as it probably used to be 20 or 30 years ago, where it was all kind of clear cut with the event of algos and algo trading. Things have become a bit more complex. And so what generally happens is you can't explicitly say, oh, this is the point where a regime change from one to the next. Of course, in hindsight, you can always do this, but going forward, not so much. Now, however, what an AI, especially in combination with alpha factors, if you have any alpha insights, can do is it can pick them up implicitly and actually react to the changes it sees. So, for example, a regime change is often accompanied by a change. If you do a principal component analysis, it's often changed by the way principal components of your system are stacked. So this is, for example, something that a neural network would see as well. But of course, there's many other permutations of that theme. So to answer your question again, it will not do this directly, but it will definitely do it to an extent implicitly. Of course, that also depends a little bit on how well your system is set up. So I hope that answers your question. Thanks very much for asking it, and maybe we can move on to the next one.
Sure, Dr. Stark. So the next one is by James. James is asking, what type of AI have you used for your portfolios, and would you recommend cloud development for it?
Okay, so thanks, James. So basically, for this particular thing, we choose an LSTM. Why? Because LSTMs are very good in actually dealing with the complexity of time series, and so they're a really good choice. And you can actually see if, for example, you run an LSTM versus a standard neural network, that there is definitely a solid improvement in actually using an LSTM versus a standard network. Now, cloud if you ask about cloud development, so when you actually use the code for this particular workshop, you will find, for example, that you can put it on a Google Colab server. So and Google Colab, as you might know, actually uses TPUs, which is also called TensorFlow processing units, which are basically cloud computing, and it's relatively fast cloud computing. So you can technically directly, by using, for example, something like Google Colab, make use out of their better computing capabilities. Now, if you want to do this yourself, of course, you can use cloud machines as well, if you have access to more computing power. It really depends. I mean, if you, for example, have access to GPUs, it's not too difficult to adopt, for example, TensorFlow to using GPUs. It only needs one or two extra lines, and you actually get a pretty significant speed up. So I often do a lot of my work on my personal laptop, and I always feel that I wanna actually get solid performance out of relatively modest computing power before I employ much more complex technology, because often getting all the gains that you can possibly get with low computing power is good, and then once you know you absolutely maxed out all your capabilities, then move to more computing power is, in my opinion, the best way to go. But of course, that's debatable. Everyone has their own style, and yeah, that's something that depends on your capabilities as well. Okay, well, thanks, James, for the question, and maybe we move on to the next one.
Sure, Dr. Stark. So this next one is a very long question. So this is asked by Marcelo. Marcelo is saying, Doc, thanks for the presentation. Fantastic work. Congratulations. At the end, I have my own company and I'm running it into a single stock using brute force algorithms and backtesting to achieve better results. Is there a way I can apply your AI concepts to maximize my algorithm return, even though I'm not using portfolio, but rather optimizing the algorithm parameters itself?
Um, so if you work on single stock, it's a little bit more difficult. I mean, this algo generally is designed to maximize portfolio management. Now, there is another aspect of this, though. So for example, I was talking about diversification. One other way to diversify is, let's say, if you just trade on a single stock, let's just say you have maybe 5 or 10 different strategies that are all relatively low correlated to each other. You can actually use those and plug them into the portfolio management systems as if they were uh, all individual stocks in their own right, or individual assets. And then you can run this through the portfolio management system and size, or basically size your individual trading strategies, and size how much capital is allocated to each of those different trading strategies. Now, I'm not sure whether that's actually the system that you have. If you have a single strategy, a single stock system, then probably you won't need that particular technique. So yeah, is one of the questions that is a bit tricky to answer, but I hope I gave you some ideas of things you can do.
Thank you, Dr. Stark. So, Marcelo, I hope this answers your question. Uh, the next question is by Yuma. Yuma is asking, how do we choose between deep learning models or other non-deep learning machine learning models like light GBM? Is deep learning based method always better?
Um, Good question. I would say definitely not. Deep learning is not always better. In many cases, when you run trading strategies, you could often say simpler is better. And the reason why deep learning works in this particular case for portfolio management is really only after you make a few tweaks to the neural network, specifically designed to work in finance and basically avoid overfitting. If you don't do that, and if you use neural networks as they are normally designed, you probably won't get a lot of good performance out of it, especially not going forward out in your out of sample data. Now, in many trading strategy, so there's a difference also between say normal machine learning perhaps and deep learning. So machine learning as such can be used for say portfolio management and so on. But yeah, it has a few properties that are not so favorable. Now, having said that, for standard alpha insights or trading strategies, in many cases, it's actually probably more desirable to use machine learning strategies rather than deep learning because, as I said, the propensity to overfitting is extremely high, and neural networks in many cases do tend to overfit somewhat, and it's not easily avoided. So I would say the answer is not clear cut. It really depends on your use case. A lot of the standard machine learning models are also more linear models, and often in finance, linear models do perform not better but more robust. So I would say, as always, it's very nuanced, and you have to see. But if you use it for alpha insights, I would recommend maybe look at machine learning models for before you actually move to deep learning. It can be an advantage. I'm not saying it's always like that, but I would say, from my own experience, it's likely that you might find something good in the machine learning space. Thank you.
Thank you, Dr. Stark. So, Yuma, I hope you got the answer to the question. This next question is by Francisco. He's asking, will there be content about forward-looking asset allocation optimization rather than using historical returns during the course?
Um, I'm not exactly sure what you mean with that, but what we're actually, I mean, clearly we have only, in a sense, historical data to go by. But what we will do in the course, though, is basically build the strategies in a way that we we basically run the portfolio optimization over the whole time series in a non backward looking way. So basically, we use a walk forward optimization system to have our whole strategy part to be calculated out of sample. So at no point we will just optimize on the backward looking data. Now, when you apply a neural network looking backward on data, you get these perfect P&L curves with a Sharpe ratio of 7. And of course, this is completely unrealistic going forward. The beauty of using neural networks is that it's actually more robust in getting good out of sample results, so data that we haven't seen, than mean variance optimization. You can really see that when you compare the two, that there's some significant improvements going from mean variance to AI portfolio management. So I hope I answer your question correctly. When we build a course and we build a backtest of the course, we're basically using walk forward optimization to avoid any sort of overinflated in sample results and make sure that what we test is actually all out of sample. And yeah, I hope that answers your question. And
Thank you, Dr. Stark.
let's move on.
Yeah, Francisco, I hope that answers your questions. In case if you have any follow-up question on this, please add in the questions panel. So I'll pick that as well. Meanwhile, let's move on to the next question. That is by Gaurav. Gaurav is asking, what aspect of portfolio optimization does AI enhance for a long-only portfolio? Does it find best possible weightage for statistical variables like Sharpie or covariance, etc., or do a better testing than Monte Carlo simulation, or if anything else, then please explain the real technical advantage.
So Kshitij, you actually broke up for a little bit, so I'm not sure I actually heard
Let
your
me
question correctly.
Sorry, my bad. So let me repeat the question. And Dr. Stark, one thing that we can also do is you can also see these questions. So if you see on the right side panel, you have a question. So expand that.
Just
There, it is by Gaurav Sahni at
okay,
5
okay.
on. I have flagged this question, so you can simply see this. But I'll again, for the benefit of our
So
audience,
who was it again? Who?
it is Gaurav Stani asked at
Oh,
509.
Gorostani, yes. What aspect
Yeah.
of portfolio optimization does AI enhance for long-only portfolio? Does it find the best possible weightage for statistical variable or do better testing? Oh, okay. Great question, Gaurav. So in fact, it actually finds the best weightage for example, the Sharpe ratio. Now, um, what I do in the courses basically, I show how to build an AI that gives you the best weightage for example, something like Sharpe ratio. And what we then also do in the courses as a capstone project, you actually design your own optimization metric. So for example, you could use other metrics such as in the simplest case maybe a Sortino ratio or a MAR ratio. And so one of the projects in the course is actually to define your own objective function that you can then use. So this is really what the AI does. It finds the best possible weights given that objective function, may it be the Sharpe ratio, Sortino, the MAR ratio, and so on. So yeah, you're correct. It's your first suggestion, not the second one. There is a second question. Do a better testing than Monte Carlo simulations of anything else, and please explain. So the technical advantage is effectively that in a way, like you have a lot more options of tailoring your portfolio management using AI than using mean variance. With mean variance, you're somewhat limited in the things you can do. And the technical advantage of AI is that you have a wider variety of options to manage your portfolio effectively than you have with mean variance. And I think that's a pretty significant. Okay, thanks for that, and let's move on.
Sure, Dr. Stark. So, Gaurav, I hope that answers your question. The next question is by Victor. Now, Victor is asking, could we incorporate alphas who don't necessarily improve the performance metrics of the portfolio and let the portfolio management ML model do the allocation for us, which means we would not have to select alphas in the first place to avoid overfitting?
Great question, Victor. Now what's interesting is, and I do this in the course, um, I actually built first a portfolio management system, and it's actually done without alphas. And what we then do is we just plug in some nondescript alphas that not actually do any, they haven't actually been necessarily tested uh, to to provide profitable trading strategies in and of themselves. But even so, you can still show that some of these nondescript alphas still improve the performance of the portfolio management systems. It's really interesting, and there's been a lot of research in the last 2 or 3 years on this topic. Some of you may have heard of it. There is this effect that you see in deep learning called double descent, where you actually really increase the number of input features well beyond the size of your data, and you actually first of all get an increase in the error rate, but then you actually get a massive drop in the error rate again. So it basically shows that even if you use a large amount of features, it's not necessarily bad for the AI. Now the features have to be somewhat related to what you're actually trying to manage, like your portfolio. So if you plug in the number of whales occurring at any given time around in Sydney Harbour or something like this, that's obviously not going to help. But if you have features that don't necessarily provide profitable trading strategies, but they have some sort of information on the time series in them, it can actually help the portfolio management system. And so, yeah, the answer is definitely it's possible to incorporate those and more nondescript features and actually get an improvement.
Well, thank you, Dr. Park, for answering that question. So, Victor, I hope that is the answer. Now, the next question is again by Samir. So, Samir is saying one more question. In terms of the portfolio rebalancing in the graphs you had presented, was that a daily, weekly, or monthly exercise?
So in the graphs, I just presented some really basic stuff. And basically what I did is I trained the AI up to the point with the dotted line, and then I just ran the portfolio management system on a daily basis, sort of updating the portfolio based on the alphas, and then managing the positions over that time. Now, what's happening in the course as well is that instead of just having one in sample out of sample split, we're actually using a walk forward optimization, where we're basically updating, or where we're retraining the AI every year, every month, every week, and so to actually get a even much better performance out of it, because we're updating our beliefs more often. So so yes, I mean, the charts only show an in sample out of sample split, but a big part of the course will be actually using walk forward strategies to update our AI model, and then applying it to an out of sample period, which we then, which is then also the same period that we step forward to into the next period. I hope that answers your question, Samir.
Thanks, Dr. Stark. Now, this next question is by Angad. Angad is asking, to build a base for this course, any good book for portfolio management that can help as a beginner? And obviously, apart from books, you can also suggest some resources that may be helpful.
Um, so I mean, there's a whole lot of books. First of all, written in portfolio management. Now, I always say, well, if you're so inclined, probably my favorite book of all time is a book by Grinold and Kahn called Active Portfolio Management. I call this a little bit the Bible, at least in my work, and it's really the basis. If you really want to understand this stuff, Grinold and Kahn is probably the best work. Now it's 700 pages and it's quite heavy on the mathematics, but if you actually work through it, it gives you unbelievable insights. It's quite amazing, and I think it's a worthwhile read. In terms of AI, there's a whole bunch of books, and I guess um, Marcos Lopez de Prado, Advances in Machine Learning for Finance, is one of the books where you get some insights. But there's quite a few others. You don't necessarily need any strict preparation. I hope the course will cover a lot of what you need, and maybe it's even better to maybe start the course, and then once you see, hey, there's a few gaps in what I need or what I understand, then go out and get the relevant literature of where you feel there is a gap. I think it covers a lot of it, but of course there's always some more that we can learn. So I would recommend perhaps even just get started, and then cover your bases as you go along. That's generally the way I work anyway. If I get into a new field, I just start a project, and then as I go along, I get the necessary literature, because if you try to read everything beforehand, there's probably a lot of stuff that you really don't need. You spend a lot of time, and this time could actually be much more usefully employed pushing your project forward and getting to where you want. So obviously it's a question of philosophy of learning, but that's generally my favorite way of doing things. Thanks.
Thanks for the guidance. Angad, I hope that was helpful. Um, Samir added a comment. He said that previous question was about portfolio rebalancing. Uh, I
Oh,
think
okay. Oh, right. Okay. So oh, sorry, Samir. Maybe I got this a little bit wrong. So of course, in the course we're actually doing a portfolio rebalancing daily, but you equally can use this for weekly or monthly or whatever 6 monthly rebalance. It really depends on the strategies that you use in your trading. You know, whether it's whether you're a fund manager or in a super fund, or you work in a hedge fund, or you trade your own money. There's all these different needs. So what I did is in the course I kept it, of course, reasonably clear, and so daily rebalance is a pretty obvious way to do it. But of course, it's very easy to then extrapolate or employ this with other lengths of rebalances, depending on what your needs are, and of course, also, you know, given a certain turnover, you probably have some constraints in the type of broker that you use and the fees you pay and so on. So it really depends on your needs. What you need to do. Obviously, I can only present a base case because I don't know what everyone's requirements are. If I knew, that would be great, but I had to make some simplifications here to you know to get the course suitable for broad audience. Hope that helps a bit, Samir.
Thank you, Dr. Stark. I think we just have 2 minutes left, so I'll pick one last question. And this
Sure.
question is an interesting one because there is not a lot of content around it. So I thought let's pick this one. And that is by Tarendra. Now he's asking, can we use genetic algorithm for portfolio management?
Um, well, technically, you can use anything. I mean, um, it's not a question of what you use or what technique you use for portfolio management. The question is really, will it deliver good out of sample performance? And if I'm honest, I haven't seen genetic algorithms giving a particularly good out of sample performance for portfolio management. That is not to say that it doesn't exist or it cannot be done. It's just not something that I'm particularly aware of. Of course, if you do this in sample, you will always get some amazing performance somehow. But I think it's tricky with genetic algorithms. And yeah, personally, I haven't my and I'm only talking about my experience, of course. There will probably be some people go, "Oh my God, I've done this so many times and it's amazing." But yeah, I'm not particularly aware of something that truly works and truly improves, say, over the base case of mean variance optimization in this. And so I would say probably difficult, but of course, I'm happy to be educated on this. I don't know everything, so maybe there is something out there that's actually better. I haven't seen it. If I was aware of it, I probably would have tried it, but so far I haven't seen anything that I found particularly useful. So I use genetic algorithms for different purposes, but not for portfolio management. Okay,
Well,
hope that
great.
helps.
Yeah, thank you so much, Dr. Stark, for conducting this amazing session and answering so many questions. And to our audience, in case any of your questions went unanswered due to the time that we had at hand, I would love to connect with you and address all of your questions. So right after this webinar, you will get a survey. Just share your questions in the survey and also share your feedback on what kind of topics you would want us to cover in the future webinars. So that will help us work on more such interactive webinars. And yeah, I think that is about it. And for this course that I was talking about, so yeah, obviously this course, so first 10 people who are going to complete this course will also get a chance to connect with Dr. Stark to discuss things in person, online, obviously. So that's an opportunity. Don't miss that out. And
Unless you want to come to Sydney, I'm happy to meet you for a coffee.
yes. Yeah, so thank you so much, Dr. Stark, for taking your time this late from Sydney, and we really appreciate it. And uh, thank you, everyone, and you have a great day ahead.
Thank you so much. Have a really good day.